Hello from Otit Markets. This is Ahura. On Thursday, July 11, we'll be with you with a short review on what we had as US inflation numbers and market reaction. Let's first of all review the numbers and the data we had, and then we can see what and how market can react to these numbers. Data had a very interesting surprise for us. Inflation, which was flat on May, market after the flat inflation on May, market was expecting a little bit slight increase as like by 0.1% in June. But that not happened because inflation fell actually by 0.1% in June. And core inflation, which is excluding the energy and food prices, increased only 0.1%, which was less than market expectation of 0.2%. Market was expecting to see the same number as we had in the previous month in May by 0.2% increase, but the core inflation increased by 0.1%. General data says that the inflation in annual scale headline number increased by 3%, which was less than 3.1% market expectation, and core inflation increased by 3.3%, which is again lower than 3.4% of market estimates. But however, these data, at the same time, we had the labor market data, initial jobless claims came at 222K, and continuing jobless claims came at 1,852K. Remember that in the last days, in a testifies that Mr. Powell had in Senate, he emphasized actually several times about that. Okay, now the inflation in the way that we want is falling, but at the same time, we have a weaker labor market, which is need to get more attention. But this data says that the labor market doesn't have any problem to get more attention. So that number is a little bit is there in a contrast. The labor market data is little bit in a contrast with what we have. And if these numbers means what it's supposed to mean, means more support from the economy, with the lowering the inflation, with lowering the rates, means that more support from the labor market again increasing the labor market, and again it can increase the inflation inflation in the markets. So still, these numbers, while the support from the more dovish expectation from the central bank decisions in its next meetings, but still at the same time, labor market data gives us some doubts about what possible can happen. Right after this data, you can see here, this is the US 10 years bond yields. You see the number 4.18, just like a few hours ago it was 4.28, 4.29%, and now it's 4.18. This number shows that the people do expect the central bank to cut the rates, and they see the lower rates in the mid and longer term. So which means we should pay more attention, we should pay more weight on the rate cut for September. And we can see that in this chart. Now, market expecting more than 78%, more than 79%, almost 80% chance. Market gives more than almost 80% chance for rate cut by 25 basis points in September meeting. And what's interesting, for July meeting, the chance of holding the rates at the current level was more than 98%, and now it's less than 92%. And the chance of the rate cut by 25 basis points is almost 9%, which it was almost 0.2%, almost 2% in like a few days ago, like just yesterday. So now the market means that these data shows that the market expects more dovish reaction and decision from the Federal Reserve. How is data going to reflect in the market? Let's check the chart. This is the S&P 500 chart. Yeah, in the first reaction, S&P 500 printed the new record of around 5,654 almost, but now decreased and again slowly increasing. Inflation is falling, but at the same time, labor market is still strong. So which means these numbers can support bullish trend, the uptrend right now we have in the market. But the labor market data is somehow pausing this movement, saying that okay, it should not go so fast because these numbers, the higher this uptrend, it doesn't comes from the better reaction or better production in the market or better economic behavior in the market. No, it comes from the better inflation behavior and not more production. So that means that the reasons of the higher levels in the market right now is not the economical supported by fundamental and economical data. So it means that we cannot trust too much on these movements, but at the same time, as these numbers means less hawkish policies, means more support from the stock markets, means more support from production. So the next month still it can increase, but at the same time, as I told, this is like two-sided knife because the labor market strong data means also more income, means more money, means more spending, and it can still hold the rates, hold the inflation higher. So for even if we go for one rate cut in September, it doesn't mean that the second rate cut can happen in 2024, and we have to wait for more data next month. So for now, the stock market can get supported, can take advantage of this. Can increase a little bit, but as I told, it cannot increase too fast. Same for US dollar index. US dollar index got under pressure and now is falling towards 104 mark. Even if it falls under 104 marks for a very short time, it can be a very short time because there are too many other reasons. And remember that 104 is the key pivot for US dollar index. If it falls under 104 and keep holding under 104, the lower digits around 100, 101 is the next step. But still, right now, we have too many other reasons in the markets as a geopolitical reasons or economical reasons in other countries that still they can put the US dollar in demand. So the international demand for US dollars is still high, which means much lower digits for US dollar index is not something that we can see right now at the short term. So for now, we can expect US dollar index to move between 100 and 104 and 104.70 marks. This is the general data and their meanings in the market and their action in the market. If you had any other question, please don't forget to write down in the comments. I will try to get back to you as soon as possible. Have a good time. Bye-bye.